Derivatives is something that you should do after fixed income because it is quite connected. So generally people do derivatives after fixed income and then you follow alternatives and portfolio. Derivatives, as such, what you can see right now is that there are around 10 readings. In reality, there were not too many readings. They just split that. So these readings are very short. They're not too lengthy at all. Okay. Majorly, the focus of derivatives over this readings is the weightage, which is as of now around 5 to 8 percentage, but you should expect around 10 to 12 questions. So this is quite scoring, but you have to be very careful whenever the weightage is very less, because that's where you have to be very precise. Okay, most of the derivative questions are not lengthy. All right, they're very brief, and there is no lot of calculation. Of course you should expect some calculation, especially when it comes to options and so on, but I'm trying to put as many as varieties that I think are important from my angle. Okay, let's start with this flow of readings, everyone. We will start first with, it's going to be not taking too much of time, but still derivatives is very crucial. I find these smaller topics more important. Okay, now before I start, let me just give you a brief that derivatives has four instruments that we are going to talk about: forwards first, then futures. Two of them have similarity. For that, I've put up my revision book also here out so that you can get an idea of what type of content I have put there relatively. So some concepts you might completely not understand then. And then after forwards and futures, you have swaps and options. All right, perfect. Let's start. Okay. Forward contract specifying only the gains and losses are exchanged at settlement. Those contracts which are only exchange, or which are only, they are done, the contracts are only gains and losses. See, there are two types of contracts. One is where there is a physical delivery, am I correct? And then the other is something where only gains and losses are exchanged. Now, the question that I've put here, the first itself, is very tricky, because what happens here is that there is quite a similarity between B and C. Most of the people know delivery is physical delivery, right? Cash settled contract and netted. What is a netted contract? What is a netted contract? See, there is in reality, there is the contract is not, there is nothing like a netted contract. There is called netting off is a process. Okay, so the contracts are called deliverable or cash settle. There is nothing as such a netted contract. It's just to create a confusion. We do the netting off, but there is nothing like a netted contract. There is a deliverable contract and a cash settle contract. Everyone, right? So the answer is B. B. Netting off means cash settled only, but there is nothing like netted contract. Are you with me on this, everyone? Understood how accuracy matters of words? You can't argue with the institute that, oh, it means the same thing. No, you need precise words. I have many students arguing that why this, why not this? No, you have to be very precise with the words that they want. All right, everyone? Cash settled. Next, in futures market, I want everyone to answer. The primary role of clearinghouse. See, the biggest difference between future and forward is that in futures market, you have a assured or a guaranteed outcome, guaranteed settlement because of the exchange, right? And that is done by a clearinghouse. Everyone, what is the answer here? What is the job of the clearinghouse? They make sure that the transaction happens smooth and there is no default risk like forward. So they act as a guarantee to both sides. And can you tell me how do they do, how exactly they do so? By taking margins. All right. Next, which of the following statement regarding a forward commitment is least accurate? You're looking for a wrong statement. A forward commitment is a contractual promise, can involve a stock index, is not legally binding. They are asking for something which is least likely. Everyone, least likely, least likely, least likely. Guys, the forward contract is legally binding. Is legally binding. Not legally binding? No, forward contracts is a legally binding promise. It's a contract, it's a promise, correct? It can involve any asset, but it is a legally binding contract. So when they are saying it is not legally binding, that is incorrect. Many of y'all who don't know this, mark it. Understood? All right. Next, these in between, they have put some questions related to options also in the first reading. Although option is to be done at the later part. European call option on stock has an exercise price of 42. It's a call option. On the expiration date, the stock turns out to be 40. So on expiration date, the stock turns out to be from 42 is my strike price 40. Now it's a call option, guys. A call option is exercised when on maturity, ST is greater than X. This option will not be exercised. Am I correct? So the value of the option is option which is not exercised. It's positive or negative? It's not negative. For option, when it is not exercised, it is OTM or ATM, the intrinsic value is zero. It cannot be negative. Option value are never negative for especially the long. Here they're asking option value. It cannot be negative. If they don't mention anything, it's always from the point of view of long. All right, everyone, check, check, check. This is an OTM option, so it is out of the money. So the intrinsic value is zero. Everyone with me? Why is everyone not answering? Check, check, check. Everyone, you should try. At expiration, that is on maturity, the value of the call option is greater of, see, on maturity, it is maximization of zero or the difference between spot on maturity and X. So it is greater of zero or underlying asset minus exercise. Am I correct? At expiration, the value of option, is it going to be this underlying asset price minus the exercise value or exercise price? See, look out for the words. Those students who argue with me, why are you so obsessed with the words? It's a trap. Underlying asset price minus exercise value. No, it is exercise price. To all those who argue that how does the word matter? No, the word matters here. Exercise price, exercise price. All right, everyone. Understood this? The settlement price of future contract. Remember, futures settled each day. Am I correct? Is the price of the last trade of the futures contract, the price of the asset in the future for all trades made in the same day? No, not all trades. The average of the trade price over the period at the end of the trading session. Yes, please. See, futures are settled at not the closing price. They are settled at the settlement price. And what is settlement price, guys? Settlement price is nothing but the average during the closing session. The last 30 minutes or so during the closing session, whatever is the average price during that trading closing session, that is called the settlement price. Are you with me, everyone? Understood? Very critical. A financial instrument with payoff that depends on a specified event. Specified event. Only if something happens, then I will be paid. That's a contingent claim, isn't it? Contingent claim, default swap, contingent claim or option, guys. Now, many people would say, sir, why not an option or a default swap? Guys, option and default swap are together part of contingent claim. So contingent claim is more comprehensive. A and C are not wrong, but B includes both. Are you with me? Understood, everyone? I'll repeat, A and C are not wrong, but B is inclusive of both. Okay. Next, a call option. I want you all to try. Come on, guys. You all are not taking the risk. A call option has an exercise price of 120. Stock price is 105 at expiration. First of all, it is out of the money. Correct? Out of the money. Anything which is out of the money, its intrinsic value, its value of the call option has to be zero, zero. Check, check, check. Everyone. All right. They asked you for the expiration day value of the call. Guys, if it was not expiration, I cannot say zero. On expiration, the time value is also zero. So OTM is zero. And here the time value is also 0. Together becomes your option price. The intrinsic value is 0. OTM. So your intrinsic value is 0. All right, everyone. Easy. Now, next one, try this. It's about a put option. Okay. On expiration date of a put option, if the spot price of the underlying asset is less than the exercise price, when the ST is below X, isn't the option in the money? It is in the money, right? So in the money options are always, in the money option means they are positive. Am I correct or no? Yes, but they're asking on which date? On the expiration date. So the time value is 0. So all you need to focus on what is the intrinsic value, the difference between whatever the spot and that is going to be the intrinsic value, which will be definitely positive. Everyone with me, the answer has to be A. All right, everyone, please confirm. Next, consider a call option with an exercise price of 32, exercise price or strike price. The stock price at expiration is 41. This is a call option. What is the value of the call option? Now, guys, here the value will be the difference between 41 and 32. The answer, since it is in the money, the difference between 41 and 32, that is 9 will be my answer. Everyone with me? Check, manageable. All right, till this point. Okay. At expiration, the value of European call, guys, on expiration, what will be the European call payoff? ST minus X, right? ST minus X, spot on maturity minus X, correct? For the European call is equal to intrinsic value. By the way, this is what? This is nothing but the intrinsic value is equal to the asset price minus the present value of exercise price is less than the that of the otherwise identical American call option. Guys, in call option, whether it is American or European, it doesn't matter. It does matter in the put option, not in the call option. In the call option, American or European doesn't matter. So C is not the answer. Now, on expiration, this is intrinsic value and time value. But on expiration, the time value part is 0. So the only amount that I will receive is the intrinsic value. Everyone, the answer should be A. Amazing. Why A? Because on an expiration, there is no time value. So it's only intrinsic value. Whether the option is in the money, then it will be positive. If it is out of the money or at the money, it will be 0. All right, everyone. Next, answer me this. This is very interesting. Credit default swaps are least accurately characterized as contingent insurance or forward. Everyone, your answer should be without the question mark. A, B, C. See, guys, credit default swaps are insurance against a default of the bond. So they are based on a credit event. So they are contingent claims, but they are not forward commitments. However, all other swaps are forward commitment. Swap is a series of forward contract. All the swaps are forward except CDS, except credit default swap. All right. Yes, it is least likely. Clear? Right. Next. A corporation that employs hedge accounting and uses interest rate swap to offset changes in the value of the fixed rate bond liability is said to be employing a. Now, guys, there are three types of hedge: net investment hedge, and cash flow hedge, and fair value hedge. Cash flow hedge is for hedging the cash inflow and outflows. Fair value hedge is the hedge for hedging your asset liabilities. So it's related to your assets. So fair value hedge, here they are saying to offset the changes in the value of the fixed rate bond and liability. Whenever you're trying to hedge your asset or liability, that is called fair value hedge. When you're trying to hedge it for a foreign subsidiary, then it's called net investment hedge. Are you with me on this? Yeah, I think let me show you this fair value hedge. See here. When it's about foreign subsidiary, It's a net investment value hedge. Fair value is about assets and liabilities. All right. In the context of determining option prices, which factor is not directly observable? Which factor is difficult to observe? Okay. Volatility of the underlying exercise price or risk-free rate. Which factor is difficult to find? Which one? Which one? Which one is easily visible? Risk-free rate, volatility, or exercise price? In the context of determining option prices, which factor is not directly observable? Everyone. I have so many different answers. A, C, anyone with B? Okay. See, the factor which is which is very difficult to observe is volatility of the underlying. That's why we do what? That's why in most of the cases, option pricing model, people don't use to find the value of option. They rather take the option value and find the volatility. They do the reverse calculation, which is what we call as implied volatility. So finding volatility is a challenging task. All right. Understood this? Next, hedge accounting with a net investment hedge most likely refers to the company that is using derivatives to reduce the volatility of, I just discussed, net investment hedge. Remember the word net investment hedge. The previous hedge that we discussed here was the hedge related to which hedge? Fair value hedge, which was about asset and liability. Whenever they say net investment hedge, that is for hedging the value of the foreign subsidiary. All right, everyone. Next, the calculation of derivatives values is based on the assumption that, wow, very interesting. Now, these are some very interesting questions which people don't realize it. They are focused only on the valuation of options and all. Investors are risk neutral. Arbitrage opportunities are exploited rapidly. Arbitrage opportunities do not arise in real market. Investors are risk neutral. The calculation of derivatives values, they are based on what? Remember the forward formula. What is the name of the forward formula called as? What is the name of forward formula? That's where the hint is. It's called no arbitrage forward. Do you remember this? It's called no arbitrage forward. Are you aware about this? The forward formula that we are supposed to do F0 equals to, what is the forward formula? Forward equals to S0 into 1 plus R to the power T. This is a no arbitrage forward. This is based on the fundamental that if the price is not this, then the arbitrageurs will exploit the opportunity and make sure it is this. So the calculation of derivative values is based on the assumption that arbitrage opportunity, if any, can be exploited immediately. Everyone, very, very important. Investors are risk neutral. Yes, investors are risk neutral for what? For taking risk free as a discounting rate. So in derivatives, when we do the discounting rate, we do it on the basis of risk free. Unlike equity, where we add risk premium also. See, all this is extra knowledge, not required for your level 1, but I'm just giving you. Where in derivatives, the discounting is risk free because investors, we assume they are risk neutral for discounting for the opportunity cost. But when it comes to valuation of asset in derivatives, or when it comes to calculation whether I should proceed with buying or not, that is the time we assume that arbitrage, it's not that it will be impossible. Even if it is there, it will be exploited immediately. That's a more accurate statement. All right, everyone. Correct. And again, I've told you that, see, one statement is right. That doesn't mean others are completely wrong, outrightly wrong. No, but this statement might be more accurate. Got it? Next, other things equal an increase in the storage cost. Guys, what is the no arbitrage formula? Now I'll again write F0 equals to S0 into 1 plus R to the power T. Add the cost at the present value of cost. minus we do present value of benefit, which is what we call as convenience yield. Now, cost is added, benefit is subtracted. So they are saying when the increase in the cost, when the cost increases, what will happen? Yes, everyone. No effect on no arbitrage. No, there will be an effect. In decrease or increase? Everyone, come on, answer this. As the formula itself suggests, since cost is added, it will increase the price, isn't it? Everyone? All right. Next. Which of the following is most likely to increase the no arbitrage price? Again, lowering of the storage cost? No. High dividend? See, high dividend is benefit. If the dividends are high, it will rather reduce the price. Lower convenience yield of a commodity. What is the convenience yield, guys? See, benefit in stock is called dividend. Benefit in commodity, the non-monetary benefit in commodity is called convenience yield. So if the benefit is less, then the price will be higher. So which is C. Again, everyone with me? Understood this? Okay. For an underlying asset that has no holding cost or benefit, neither cost nor benefit, the no arbitrage forward price will be at initiation will be simply spot into 1 plus r to the power t, which is ABC. It's not going to be 0. The future value of the spot or equal to spot. It has to be the future value of spot, isn't it? What is future value of spot? As 0 into 1 plus r to the power t, not C. Why should it be equal to spot? Forward will not be equal to spot unless on the last day. They are asking you at initiation, forward is equal to the no arbitrage forward is spot into 1 plus r to the power t. Cost and benefit, if it is not there, this is the formula. All right. Read the statement carefully. Derivative questions are not too lengthy, only 1 or 2 lines. All right. Next, for an underlying asset that has no holding cost or benefit, the value of the forward contract to the long during the life of the contract. Now, see, they use the word value. What is value? What is value? See, if you see my notes, value is the gain or loss to the long. I'll repeat, value is what? Value is the gain or loss to the long. Those who have this world famous book by Dr. PhD, here you will see the value is nothing but the gain or loss in the forward. So whether it's inception, in between, or at maturity, value is the gain or loss for the long, which is the difference between the price at which he sells and the price at which he buys. So the buying price, that is the forward price, is what you pay, and the price at which you sell or settle, that is a spot price. So it's a difference between the spot and the present value of forward. So what is the formula for value for forward? Value is the difference between spot on that day minus the present value of forward, whichever day you settle. If it is at inception, it is always 0. Value at inception is always 0. Now let us see the question for an underlying asset. Okay, the value of the forward contract during the life. During the life means in between. It's spot minus the present value of forward, the difference between spot and forward, present value of the difference between the spot and the forward. So tricky. I've already given you hint. Let me know. What is going to be the value of the asset? It's a difference between spot and present value of forward. Everyone check, check, check. A. Isn't it the accurate word? All right, everyone. Clear? See, value is gain or loss. Understood? The most likely use of forward rate agreement. What is forward rate agreement, guys? Forward rate agreement is similar to what you did in bond 1Y, 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 2Y. Remember 1 year forward after 1 year, 2 year for 1 year forward after 2 years, and so on. Forward rate agreement, FRA, is done to lock the rate for the borrower or the lender. So it's generally used when you're going to borrow or lend after a period of time. So the utility is the same as any forward contract. You want to lock the price. Here I want to lock the rate. So the answer is lock in the interest rate for future borrowing or lending. Absolutely correct. Exchange of floating, no, that is swap, right? When you exchange one for another, that is swap. Obtain a right but not obligation, that is option. So this is for swap, this is for options. So the A is the only answer. All right, everyone, so easy. The value of the forward or future contract is specified in the contract is typically zero. If you know, if you have seen my videos or something, I have said that the value of any contract at inception, whether it's forward, future, or swap, whether it is forward, future, or swap, at inception, the value of the contract is always zero. At inception, it is always zero. Check out my note. At inception, it is always zero. Only then you enter the contract. Otherwise, you don't enter into the contract. Are you with me on this or not? You can do any mistake, but not this. This is very important question. Clear, 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 clear. Check, check, check. Everyone, those who answered correctly this, let me know. Okay, someone is saying me I misread. Brothers and sisters, you, okay. If it's not visible, it's my mistake, but one liner, don't misread. Okay. Next, at time T means in the middle, somewhere in the middle during the life. Prior to the settlement, okay, the value of the long forward price F will be related to the spot S of that has zero net cost of carry by, okay, so there is no cost or benefit. First of all, how do we do this? Value is the difference between the spot minus present value of forward, which is 1 plus risk free to the power whatever is the maturity minus where exactly are we right now before maturity. So it has to be this. So the answer has to be forward, okay, minus the present value of the spot. Sorry, it has to be spot minus the present value of the forward. So I have the spot minus the present value of the forward. By the way, all this is to the power, okay? All this is to the power, to the power, to the power. Yes, which one is the correct answer, everyone? A, B, C. Which one do you think closest to the correct answer? Check, check, check. Don't worry, we don't move ahead unless all of you answer. It is C, spot minus the present value of the forward to the power. Negative means present value. Now see, you can either write this or in the denominator, or sometimes people multiply in the numerator and write negative. Whichever you do doesn't matter. Okay. So in between, this is the value. Spot minus present value of forward. Understood this? For me, these are very important questions. They don't generally ask you calculation, but they want to see whether you know the concepts. One of the very important concepts in my futures note is this, where I've said the students that this is so important, that how the interest rates and prices of futures are connected, if correlated. Based on that, you will get to know which contract is better, forward or futures. Okay, the long futures contract may be preferred, means, see, it doesn't matter long or short. Futures contract may be preferred equivalent to the forward without central. When are future contracts preferred? When the rates, when there is a positive correlation between the two things. What? Between the price and the futures. So between the interest rate and the price of the futures. So when interest rate and the price of the underlying, when they are positively correlated, that is the time futures are more valuable. See here, if the interest rates are positively correlated with futures, then future is better than forward. Otherwise, forward is better. But when they both are same, it doesn't matter. Understood? For a futures contract, okay, by the way, very important, this one. Okay. For futures contract, the adjustment for changes in settlement price from one day to the next day will result in, what is that from one day to the next day? Okay, what will that create? No change in the contract price, but a change in contract value. A change in contract price, but no change in contract value or changes in both. So important it is. When you go from one day to the next day, from one day to the next day, what happens? Contract price changes every day. But why no change in the contract value? Because every day after settlement, what happens after settlement? What happens after settlement? After everything is settled, the contract becomes zero. Why does the contract means the gain or loss? After settlement, the gain or loss becomes zero. Why? Because futures have to be compulsorily settled each day. So every day is a new price. And after the settlement, no gain, no loss. Understood? Very important. If I were an examiner, I would have definitely put this question. All right. Compared to interest rate futures contract and otherwise equivalent forward rate agreement will see forward and futures. The difference is clear. Forwards are more risky, right? Have greater volatility, have greater payments for a decrease in interest rates, exhibit greater convexity. This is a very important question. See, in futures, the payoff is linear. In forward, what happens in forward? The contract might, okay, so see, just to give you an update, what happens in forward rate agreement, although this is not a part of syllabus, but let me tell you, because without that people don't understand the payoff. What happens in an FRA? Suppose you want to borrow for 100 days after 20 days. So in reality what happens is that the settlement of the interest takes place on 120th day after the loan starts, but the forward unfortunately is settled on this date. So you have to bring the present value of forward. So therefore, the payoff of forward and future is not same. In forward, the rule is they settled earlier. In futures, they don't settle earlier. They settle it on each day. Because of this, the forward price and the future price are not same. Understood? This concept will make sure what that the forward price are actually discounted, and therefore what do we say? That they exhibit convexity. Please remember this. Forwards forwards exhibit convexity because of this awkward or complicated settlement that they do before instead of doing the settlement on 120, they settle earlier. Now, many of y'all who might not have this idea, you will have to read and understand this concept of convexity only applies to forwards. Okay, clear? Which of the following is typically equal to zero at initiation? I just discussed that at inception, the value of forward, futures, and swaps, all three zero. So it is the value, not the price. All right. Doesn't matter whether it is for forward, futures, or swap. For all, it is zero. At inception, the value is zero. Clear? And investor could best replicate the position of a floating rate pair. Now, this is what I'll have to show you. What is a floating rate pair? A floating rate pair, let's say someone who's paying floating. Now, whenever you have to pay float, that means you will receive fixed, isn't it? That means you are going to be receiving fixed. Now, guys, when do you receive fixed rate? You receive fixed rate when you have invested in the bond. When you buy a bond, you will receive fixed coupon. When they say the word receive, that means you have a buy bond, you have bought a bond. But when you're paying, that means you have sold a bond or you've issued a bond. So that means I've sold a bond. Now I'm paying floating. I'm paying floating means I have sold a floating rate bond and I'm receiving fixed. That means I've invested in a fixed rate bond. So I've sold a floating rate bond means I've borrowed at the floating rate. Am I correct? I've borrowed at the floating rate. These two are correct. But I'm going to receive fixed. That means I have bought a fixed rate bond. Am I correct with B? Everyone understands this? Why B is the answer? Check, check, check. Clear? How are the questions? The the ones that I've shortlisted. Interesting, isn't it? If it is causing pain in your head, my job is done. Great. My job is to make sure to realize you all the angles. Okay. The price of a fixed or floating rate interest rate swap. See, in swaps, the price is nothing but the contract price. Here, it is not a price, it's a rate. This rate is decided at the beginning, which is called the swap fixed rate, which is called the swap fixed rate, which is decided by both the parties at the beginning of the contract, at the inception of the contract. So the price of the swap, fixed to floating, is a plain vanilla swap. May vary over the life. No, it is constant. Is established at the contract initiation. Yes, true. Is directly related to the changes in floating rate. No, price is fixed. The rate is fixed during the life of the contract. All right. Correct. Series of forward contract to replicate swap contract. For a series of forward to replicate a swap, the forward contract must have, guys, when I say forwards or swaps, one thing is common. The value at swap initiation, the sum should be, whether it's forward, future, or swap, the sum should, the value at inception for all the payment, all the floating rate payment, all the fixed rate payment, they both should match. So what should be the case here? The present value of all the floating rate payment should match to the present value of all the fixed rate. And the difference between both will be zero at inception. So to replicate it in a swap, it should be done in a manner that at inception, it all sums up to zero. Second, at expiration, no. Values at swap initiation that are equal to zero. Values at swap initiation that sum to zero. Now, what is difference between A and C? Here, there are multiple forwards which make the swap. So all of them together should sum up to zero. Are you getting my point? Why C is not the answer? A means value at C, value of all the forwards. Put together. Put together means that word sum is very important. Sum. Put together should be equal to zero. All right. Because there are not one payments, there are multiple payments. For example, in this floating and fixed, every quarterly payments might be there. So the present value of both total should match, means the value at inception of the sum of the payments total should be zero. All right. Next. All of this related to forward futures and swaps. I've cherry picked some of the most important. I can't say a lot of things, but these are very important questions. Which of the following statement about the moneyness is most accurate? Moneyness means in the money, out of the money, at the money. Okay. You are looking for which one is more accurate. Below the strike price, the call option is in the money when the stock price. See, when the stock price is above the strike price, then the call is in the money, not below. Above the strike price, put is in the money. No. Above the strike price, the put is out of the money. Yes. Which one is the answer, everyone? C. Why C? Check here. When the stock price is greater than the strike price, call is in the money, but put is out of the money. They are saying here put is out of the money. True. All right, everyone. Correct this one. Next. The value of the put option at expiration is most likely to be increased by, see, whatever causes the call to decrease will increase the put value. Okay. Higher exercise price. Let me check. See, suppose exercise price is 100 and the spot price is 80. So here my intrinsic value will be 20. But if my exercise price is, let's say, 110 and my spot price is still 80, then my intrinsic value will be 30, right? So what is causing the value to be higher for a put? Input, the value is higher when the exercise price is high. That seems to be a correct statement, isn't it? Everyone agrees with A? A, why not C? Higher volatility of the underlying, the value of the put option at expiration. At expiration. See, higher the exercise price, definitely it will be higher, right? But why not risk-free and volatility? Risk-free and volatility, they both will only affect when there is time for option to expire. On maturity, there is no time for the option to expire. So on maturity, what will happen, guys? At expiration, time value is equal to 0. So the risk-free rate or volatility of the underlying, volatility, by the way, is friend of option, right? So they only affect when the option has time left. On maturity, it becomes 0. And they don't affect the intrinsic value, they affect the time value, which is on maturity 0. Are you with me, everyone? Clear? Why C is not answer and A? Everyone who's answered this. All right. A call option that is in the money. In the money is when spot is greater than the strike price. So in the money is everyone would want to try. What is going to be in the money here? Where the exercise price is less than the market price? True. Exercise price is greater? No. Has a greater value than its purchase price? No. Spot price should be higher or exercise price should be less. The answer is A. I see not many people answering there. Check, 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 check. All right. Next. Other things equal, a short put position would become more valuable as a result of an increase in, guys, short put, short put, short put. Isn't the short put's payoff same as, can you tell me? A short put's payoff will be same as, short put's payoff will be same as long call. Guys, long call and short put, both are bullish positions. Both will make money. Both the expectation is that the prices go up. Long put wants the prices goes down. Short put wants the opposite. Long call wants the prices to go up. So the position for both is same. So they are saying what would become more valuable as a result of increase in. So whatever causes the increasing in long call or call option, same is going to be benefiting the short put. So time to expiration, yes, higher the time, good, right? But not for European put. Higher time is good for call, but here we also have put. For put, it is not the case. Remember, there is one exception. One exception, that is European put. Let me show you. Where is it? Yes. Exception is the European put. Understood? So we are looking for put option. So that is not the A, cannot be the answer. So what is going to be more valuable when there is increase in price of underlying? Yes, because at that time the call will go up and the put will also benefit. So B as of now seems to be right answer. The volatility of the price of the underlying, guys, volatility is the friend of option. Volatility increasing will increase the long also, will increase the call also. But what about put? Will increase the chances of put being exercising. So it is beneficial for long put. Are you getting me? Volatility is good for long call and long put, not for the short ones, because short one don't want the option to be exercised. Very interesting question. It's not that easy. Understood? At expiration, the exercise value is equal to the time value for. Now, what is exercise value? See, they are very smart here. They actually mean exercise value means what? See, they use exercise. When they say exercise price, it's strike price. But when they say exercise value is nothing but intrinsic value. I'll repeat, it is nothing but intrinsic value, same, but they just change the word. So at expiration, exercise value is equal to time value. Exercise value is equal to time value. When for an in the money call or out of the money put, guys, in the money call or out of the money put will be more valuable than time value, right? On expiration, time value is equal to 0. So what basically they are trying to say, the intrinsic value equals to time value equals to 0 on expiration, right? Correct? That's what they are trying to say. It should be 0. So in the money cannot be zero. Out of the money call and out of the money put. Yes, they both are zero, isn't it? On expiration, they both will be zero. Am I correct? But if any of them is in the money, it will not be zero. Got it, everyone? Clear? A synthetic European call option includes, now this is put call parity. Now, what is a put call parity? Guys, put call parity equation I have in my notes, but I'll just share. You see here, put call parity and put call forward parity, put call parity and put call forward parity. So at one end, you have protective put, which is long stock and long put. This is protective put at one end. And on the other end, you have fiduciary call. Fiduciary call is long call plus present value of investment in a zero coupon risk-free bond. This is your put call parity. Now they are asking for a synthetic European call, means keep the call on one side and take everything else on the other side. So stock is long, put is long, but risk-free bond will be then become, when it goes on the other side, here it was long, it will become short. Short bond, short bond. So, which includes a short position on what? Everyone, very easy. I've already given you the answer. What is going on the other side and becoming short? It is the not stock, it is not put, it is the bond. Are you with me, everyone? Check, 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 check. Interesting question, right? Put call parity. Got it? A fiduciary call is made up of two things, a call option and present value of X related zero coupon risk free bond, which pays X on maturity. Portfolio consists of a call option and a bond that pays excess price of the call at expiration. Exact answer, isn't it? A, call and a share of stock? No. Call that is synthetically created? No. Everyone understood why A? Very important. Clear? Which of the following instrument is a component of put call forward parity? Guys, in put call forward parity, what we do is that in the protective put, instead of spot, we use present value of forward. Plus the rest of the thing are same. Plus you have put and here you have call and present value of zero coupon risk-free bond. So instead of spot, we replace it by present value of forward. That's the only difference in a normal put call parity and a forward put call parity. Instead of spot, we replicate it with present value of forward. So put call forward, the following of the instrument is a component of a put call forward parity. Is there a spot in put call forward? Guys, in put call forward, is there a spot? No, there is no spot. We replace that. The present value of the forward, yes. The future value of the forward, no. The present value of the forward, because that's equal to spot, isn't it? Now, I've added some question from the last reading, which many students skip. That is about the hedge ratio and the binomial. Okay. Now, I know many students might have skipped this, but I will try to showcase you how to do it in case if it comes. Okay. So here they are asking a stock, consider a stock that has a value of either 22 or 14. So I'm writing it here. The stock can either become 22 or 14 from now. The risk-free rate is 5%. What is the ratio of the share to the call option with an exercise price of 18? Guys, if it is 18 and it's a call option, can you tell me what can be the payoff? If it goes to 22, I will get plus 4. But if it goes to 14, I will get 0, not negative. Isn't it? Isn't it? So that will have the same valid expiration regarding, okay, with an excess price. If the risk free, what is the ratio of the shares? Basically, when they say ratio of the shares means they are asking you what exactly? They are asking you hedge ratio. What is hedge ratio? It is change in the call price due to the change in underlying price. The call goes from 0 to 4. So the call is either 0 on the lower side, and on the upper side it went to 4. So you can do 4 minus 0, and in the denominator you can do 22 minus 14. That's the gap between the price. So that will give you hedge ratio 4 over 8. Am I correct? Which is going to be half. Correct? The answer is 0.5. Check, check, check. Are you getting this? That's your hedge ratio. Let me also show you the hedge ratio formula. Is the change in the call price due to the change in underlying. And what does the hedge ratio say? It says that how many shares you need to buy or sell in order to hedge the option position. So it is the number of shares you need to hedge the options. So whatever is your option position, how can you share at what rate? So here 0.5 means for every option I need half share or 0.5 share to hedge. Basically, it means that you will take one share for two options. So every two options, you can take one share to hedge. That's called hedge ratio. All right. Correct. Same way, a stock is currently priced at 30 at the end of the 3 months when its options expire. The stock price is expected to go up or down by 10%. This is a question of a typical binomial model. Okay. So here in the binomial model, again, many students skip this, but you can try. I have put one question in case if they. So stock is currently priced at 30 and they said it can go up or down by 10%. So guys, I know if it goes up or if it goes down, if it goes up, it will be how much? 10% up. That is 33. If it goes down, it will be 27. Am I correct? Right? What is the value of the option with a strike price of 31? Guys, strike price is 31. So when you compare that with 31, this will be either +2 or 0. Am I correct? Right? +2 or 0. Now, what is important is that you need to find the probability of upside and downside. Now, for probability of upside, the risk neutral probability of option. For that, what is the probability of upside? For probability of upside, you require 1 plus risk-free over the down percentage and divided by up minus down percentage. Or actually, it is not the percentage, it is the down move and up move. What do we call it as? Up move and down move. Here, the up move is how much? 10% up. So that is 1.1. And the down move is 10% down. What is 10% down? What we call as 0.9. So what is the risk-free rate that they've given here? The risk-free rate. Have they given me the risk-free rate? A stock's currently price is 30. They've provided me can go up or down by 10%. What is the value of the call option with a strike price of 31? Okay, what is the value of the call option with a strike price of 31? Either you can get 2 or 0. 2 or 0. Guys, do we have the risk-free rate here? If you have the risk-free rate, then you can find the risk-neutral probability. Do we have the risk-free rate? Everyone? Do we have the risk-free rate here? Check, 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 check. Do we have in this entire information, do we have the risk-free? 30, end of the 3 months. When its options expire, the stock is priced, expected to either go up or down by 10%. What is the value of the option if the strike price is 31? Now, unfortunately, there is a correction here. They forgot to mention you the risk-free rate. You can just add on the risk-free rate from yourself. The risk-free rate is 3%. Okay. So if I do 3%, 1.03 minus the down over up minus down. Let's find what is going to be the probability. 1.03 minus 0.9 divided by 1.1 minus 0.9, that is 0.2, right? So recall 1 divided by recall 2. You should get this as 0.65. When you get 0.65, so the probability of upside is this, so the downside is this. So your expected payoff, your payoff will be 0.65 into how much? 2 plus 0.35. It doesn't matter because it's 0. All of this will happen on maturity, that is after 3 months, right? So what we are going to do, this payoff, we need to bring it to the present value. So all of this, if we bring it to the present value at discounting of 3%, we can get what is the present value of it, right? So first let's find this 0.65 into 2, the rest is 0, right? So your answer for this will be 1.3. Now, using the discounting rate of 3%, this has to be slightly less than 1.3, right? So even if I discount for 3% divided by 1.03, it will be still 1.27, which is still closest to 1.3. Are you with me? Some information was missing here, but you can, if you do the present value of it, that is going to be the value of your call option. So present value of 1.3. So the closest will be to 1.3 only. So if I do the present value of this, it will give me 1.26 roughly. The closest is still 1.3. So we choose 1.3. Understood, everyone? All right. Check, check, check. Clear, clear, clear. Now, again, we've covered as many varieties as possible. Very important from your exam, even though you're going to get 10, 12 questions, you need to make sure that everything is done precisely. Too much to study for just 10 questions, but worth it. All right.